This podcast is brought to you by True Resources, connecting talented people with the best mining employers in the Australian market. For more information, head to trueresources.com.au.
Hello, I'm Ben Kostrich, and this is the Market Bull podcast. Joining me today on the show, I'm very excited. I've listened to a fair bit of his work on various podcasts, but it's Michael Howell, the CEO of Cross Border Capital, which is an investment management firm based in London and was founded 1996. So he's been in this realm and sector and analysis for so many years, and it's my first time having him on the show today. So welcome, Michael.
Good. Hi, Ben. Great to be here. Much looking forward to the discussion. I've got to say, we're also a research company, not just a fund management group. So hopefully we're going to dig into the research of it.
Yeah, well, no, it's probably part of the reason I invited you on is I think your research side of it in particular has got me very interested. And I'm sure a lot of my listeners will be the same. But for those that have potentially never heard of yourself and your background, do you mind just taking a few moments to talk about who you are as a person and your career trajectory, which is quite interesting as well?
Okay, then let me try and dig back. Essentially, I started after graduation. I was in academia. I did a master's and PhD in finance, and then I went into corporate planning and worked for a British firm, multinational company, for about 3 years. That was largely based around the construction building industries. Then it was the time of Big Bang, for those that remember, in London in the mid-1980s, when London was the London city financial markets were basically liberalized, opened up, commissions were dropped, and a lot of American money and actually Japanese money came into London to basically restart or consolidate or improve the structure of finance in the city. And I joined Salomon Brothers. Salomon Brothers was then the probably largest and most well-known fixed income shop worldwide. It was the bond markets in many ways. It's an awful lot in foreign currency trading too. And Salomon Brothers was very much research led, I suppose, the best way of putting it. It was, essentially a trading firm, but it was very much research led. A lot of the research guys have since developed illustrious careers. They're very well known. All the pioneer work in finance was actually done at Salomon Brothers. People like Marty Leibowitz, Henry Kaufman are sort of names from the past, but they figure, prominently in textbook accounts of what went on through that period. And after Salomon Brothers, I then moved briefly to a British bank doing emerging markets called Barings, which had a celebrated failure around about the mid-1990s. And then I thought, well, this is all too much. I mean, the trouble with finance is that it's not a question of climbing the ladder. It's just a question of waiting until the ceiling comes down to meet you. It was always a very turbulent existence. So I thought, look, I'm going to go out and do this myself. I'm going to set up a company, which was Cross Border Capital. And we basically became an investment advisor around about the late 1990s. And, that's 25 years plus ago now. So a long time ago.
So where have you found that your niche skill set has really developed over this period of time, especially from the research front? And even since when you founded it, there's been incredible sorts of turbulent times across global economies and even so more emerging economies. I mean, how has that really developed over this illustrious, nearly 20 plus years doing this for Cross Border Capital?
I think there's a number of things to say. I think one of the most profound changes that you've seen in financial markets over that span of time is that, if you look at every high street and every city worldwide, you'll find a wealth manager of some description. That certainly wasn't the case 35 years ago. That's been a huge expansion. We were probably inundated with pubs or whatever it may be, 35 years ago. Now it's wealth managers. They're everywhere. And that tells you something about how the whole nature of wealth management, people's savings, the internationalization of markets has changed over that time. People are basically managing their own money, managing their own pensions where they have that ability. So I think that's one major change. When I first started in the business, back in the mid-1980s, the world wasn't particularly international. Now it's it is wholly international. We, hence our discussion right now. But effectively, we're in a situation where there is no unrelated event. What happens in America affects us all. What happens in Europe affects America. What happens in Japan, we've got to pay attention to. China is clearly, yet another issue we need to, keep the finger on the pulse of. So all these things are clearly critical developments. So internationalization was another feature that really came through. And then I think you've also got the growth of institutional investors. There was a lot of institutional money, which then started to arise because of these big savings pools that were there. This may be connected with aging populations. As a population ages, it basically tends to deploy its savings in very different fashions. You had this institutionalization of pension markets. That meant the financial markets became more sophisticated in that sense. So you've had different applications. There'd been innovation in the markets through that period. So I think that's that's another feature of what's going on. And then I think that yet another point to bring out is that the way that central banks manage the system, or the way that generally policymakers manage the system, has changed enormously. And the whole nature of the financial system has evolved and changed over that period as well. Because, at the beginning of, let's say, back in the 1980s, when I began my career, capital markets were always thought about as new capital raising mechanisms. I mean, that's the textbook definition. So in other words, you go to a capital market to raise money for a new investment. And, that's what their function is. Interest rates are all important. If interest rates go up, it attenuates the capital spending cycle. The capital spending cycle then changes the tempo of the economy, etc. A very straightforward textbook model that you can find anywhere. Trouble is, that doesn't work. That's no longer the case. We've eclipsed that because of the huge amounts of debt that the world economy has taken on, and that debt explosion has, to a large extent, been because of financial innovation. Basically, investment banks have encouraged a restructuring of corporate balance sheets. But then the other thing is that governments have found it very easy to raise money. And so what they've done is they've funded budget deficits. And let's be clear here, budget deficits worldwide are enormous and getting bigger. And that's been funded largely through government bond issues. The trouble with debt is, which people fail often to acknowledge, is that debt has to be repaid, or at least rolled over. Now, spoiler alert, it's never really repaid, it's just rolled. So most of the time you're seeing financial markets act as debt refinancing mechanisms. They're effectively operating in the roll. Now, this is the key point for understanding markets, in the here and now and going forward, is basically that debt refinancing changes the whole complexion of how financial markets work. It often makes them seem topsy-turvy, or put it another way, it changes the polarity of markets in many cases. Now, what I mean by that is just consider what's going on when you've got to refinance $350 trillion of debt, which is sitting on top of us in the world economy. That is about 2.5 times world GDP. So this is, a huge amount of money to refinance. Now, if you think of the average term of a debt being about 5 years, that means that of that 350 trillion, about 70 trillion on average has to be rolled each year. And that roll is clearly a significant burden for financial markets to take. And if you're going to roll that amount of debt, interest rates don't really matter. I mean, just think of the example of a home mortgage. If you want to refinance your home mortgage is coming due, after a 25-year duration, you want to get the roll, because if you don't get the roll, you're going to be homeless. The interest rate is really, it's important, but it's kind of a secondary consideration. You need to stay in your home. Equally with a corporate security, if you don't roll that debt, you're going to default and you're out of business. So, effectively, this is the critical point. And to roll debt, what you need is balance sheet capacity in the financial sector. So you need liquidity. And therefore, this really comes back to a critical element that, we research, and we've, hopefully made our name in terms of understanding these flows, is understanding the liquidity in markets. And because markets are now international, we look at global liquidity. So we take a lot of recognition and acknowledgement of what is happening in the cross-border markets. So that's really the story. And that's why it's important to understand these global liquidity flows.
There's so many points to dissect there, and it kind of takes my next question, which was about your focus on liquidity. But going back to the debt side of things, I mean, it's completely apparent across the world that yeah, debt continues to grow, and that, as you said, that adage, that the fun fact that debt doesn't get paid back, it gets rolled over. And more so recently, a lot of people go back to the pandemic time and some of the borrowings and the support countries took on different perspectives to help naturally businesses and people get through those times. But now we're sort of approaching these, I guess, lagging effects like rolling this debt over. And you look at the US and China as the two main ones. I mean, what sort of potentials are we looking at as these sorts of, this can does get kicked down the road, but these rollover of debt do come knocking. What sort of implications and what sort of timelines are we looking at for those two major players?
Well, I think if you come back to the problem is that debt grows exponentially, and it particularly grows exponentially for two reasons. One is that the interest bill compounds. Now, you've probably read, because it's been splashed over the media quite a lot in the last few months, that US debt interest is now running at about $1 trillion a year, which actually exceeds the amount America spends on their defense budget, which, since we know they spend a huge amount of money on defense, it kind of puts that in context of how much money is being paid in interest. But that is compounding higher. This is getting bigger and bigger over time because the debt GDP ratio of America is rising. So the pool of debt is getting larger. The interest bill in absolute terms is growing, and interest rates, generally speaking, are going up. I mean, I know they've just started a little cycle coming down, but just go back, 5-10 years, and we were at virtually zero interest rates. So the interest bill is clearly elevated relative to what we've recently been used to. And then the other factor is that you've actually got on the public debt side, you've got the fact that budget deficits are structurally embedded and large. Now, we're looking again to take the US, and I'm not hitting on the US because in many cases, the US is the cleanest shirt in the laundry here. But the fact is that the US is very transparent with its data. It does long-term projections, and the US economy is clearly important for all of us. What's happening in the US is the structural budget deficit is running at about 7% of GDP, right? Now, historically, we've been used to numbers that are nearer 1, 2, 3%. So this is a step change. I mean, just think in context, put it another way, that US government outlays are now 40% higher, 40% higher than they were before COVID. Okay, and they're not coming down, they're going up. None of the presidential candidates, none of the parties are talking about raising taxes or cutting back on spending. So you're looking at these embedded deficits going forward. And that is just basically adding to the whole debt burden, because they've got no intention of paying this back. They're kicking the can down the road. And all I'm saying is that what is different between now and maybe a decade ago is the scale of these numbers and the sort of nonchalant attitude of politicians by saying, we're simply going to, either ignore the problem, bury it, kick the can down the road, and just keep amassing these huge deficits. Now, that means that debt is growing at an exponential rate. And the US debt GDP ratio, which is currently public debt GDP, which is just over 100%, is likely to double by 2050. Okay, I mean, these are huge increases. Now, if debt is exponential, liquidity is cyclical, and what you find over time, going back, I mean, we've looked back, 50 years here, looking at the numbers. The ratio between debt and liquidity tends to be constant if you want to avoid financial crises. If you want a financial crisis, then let debt shortfall relative to liquidity. In other words, there's insufficient liquidity in the system to roll over the debt. And that then becomes a problem because you get a financial crisis. Equally, you can say on the other side, there's a cost if you have too much liquidity in the system, because then you get asset bubbles. And we know what asset bubbles do, they burst. So you create financial instability when your liquidity growth does not match your debt growth. And with liquidity being cyclical and debt growing exponentially, there's a really high risk of that happening. So in other words, central banks, policymakers have got to steer a very certain course between, whirlpools on one side and rocks on the other. And this is a very difficult task to do efficiently.
And do you reckon that, I guess we've heard that the Fed in the US in particular was talking about the soft landing, and that was the narrative, and there was a lot of expectation. And now clearly the priorities in the US has very quickly shifted to just an election cycle and the impact of politics. And there's certain conversations that are almost hidden under the rug, so to speak. But do you feel that at least the way that the US is going, what sort of potentials do we have when you're monitoring the liquidity rates and with some of these debts being rolled over? What sort of course do you think is being set? Do you think it is effective, or what sort of points do you have on that?
Well, I think the fact is that the focus of the media is to basically look at interest rates, and everything is about the next interest rate change. In America, the FOMC, the RBA in Australia, everything is about what's going to happen to rates. Okay, the fact is that this doesn't really matter that much. I mean, I'm not going to, well, it's a smokescreen, let's say. What's really important is what's happening beneath the surface in terms of these liquidity flows. And if you change interest rates by 50 basis points, what does it really mean for the flows of liquidity? That's the key question. I mean, evidence what's recently happened in China, where the Chinese announced a series of measures, but one of them was a 20 basis point cut in policy rates. Now, the markets kind of exploded in enthusiasm. There was lots and lots of false commentary or fake commentary about what this is all about. But, seriously, does a 20 basis point change in interest rates, cause the economy like China to change direction like that? Absolutely not. There's a lot more going on you've got to understand. And the fact is that policymakers have steered the public down this route of saying interest rates are all important. This is what's really governing. And if we change interest rates by a few basis points, the whole thing is going to, we're going to change the whole direction of the supertanker. That's clearly wrong. So what you've got to do is to re-educate people and saying, look, what really matters here are these flows of money that are coming into the system. And to a very large extent, they're being directed by these policymakers, but they're not really fessing up to it. Now, what's going on, to take America as another example, what's going on in America is what I call not QE, and not yield curve control, because there are two features of policy that don't really get very much recognition. One is changes in the structure of the Federal Reserve's own balance sheet. In other words, what is it really doing with money? Now, the headline says that the Federal Reserve is actually undertaking what is called a QT, quantitative tightening program, where they're actually withdrawing liquidity from the markets. Well, that's not true. They are shrinking their balance sheet, for sure, okay, but actually within that shrinking of the balance sheet, the liquidity generating parts are actually going up, right? And that's the important thing to watch. So the Federal Reserve for 2 years now has been injecting more liquidity into US financial markets. The other thing they're doing, which is not really getting a huge amount of attention, is they're changing the rules that apply to banks on bank stress tests. So they're making it easier now for the banks to fulfill their stress test targets with their regulators, which means the banks don't need to reserve so much liquidity. They can start to use that more in terms of lending to the private sector. So these things are going on, which are completely divorced from the interest rate story. And then if you start to look at the US Treasury, then you've got, again, without wanting to be caught in the weeds here, you've got other things going on. And that basically is what I've called not yield curve control. Now, yield curve control was something that commentators in Australia know a lot about, because the RBA and the Treasury basically did yield curve control there. One can debate how successful it was. I think it was pretty successful, actually, if you look at it, but that may be another chapter. But then if you look at what's going on in the US is doing a slightly different course of yield curve control. So what they're doing is that they're focusing the issuance of the US Treasury, in other words, its bond issuance, on the very short end of the market. So traditionally, the US government has issued a lot of longer dated debt instruments. So in other words, 10 years, 20 years, 30 years. In other words, trying to target the long-term savings institutions like pension funds and life insurance funds to actually use their savings to finance the government. Now, we could debate about the merits of whether that's a good or bad investment for them. That's another question. The fact is that if they're doing it that way, they are not monetizing the debt, right? They're not printing money to pay off debt. They're just reshuffling existing savings. But actually, by doing the other route of issuing a lot of short-dated debt, in other words, bills which mature within a year, 2-year coupon bonds, 3-year coupon bonds, etc., by issuing that, the main buyers tend to be credit providers like banks. And what happens if the banks buy the debt is that their balance sheets expand. And if the banks' balance sheets expand, that's monetization. So if you look at the US through this year, something like 75% of the expansion in traditional monetary aggregates like M2, and I'm saying M2 is not necessarily a great focus, but let's use that as a benchmark, 75% has been monetization of the government deficit. So the increase in money supply in America is largely because of what the public sector is doing. Now, you may have heard in the dim and distant past names like Milton Friedman, who were sort of celebrated monetarists, who were very prominent in the 1970s. When I was growing up, and what you look to these guys as sort of, icons of responsibility. And they were saying, look, don't monetize, too much money printing is inflationary, blah, blah. Well, Milton Friedman's long departed this earth, but he'd be turning in his grave because what's going on now is that these guys are going back and they're basically monetizing deficits. They're printing money. They're creating monetary inflation. This is what's going on. Evidence, the gold price. Why is the gold price at an all-time high? Hey, this is not a fake. This is real. This is what's happening because investors are starting to realize that the world is getting more and more inflationary. This is the way out. The politicians are kicking the can down the road. The gold market has realized this, okay? The gold market is an old market. It's lasted for millennia. And they recognize the fact, it recognizes the fact that this is monetization going on. It's debasing paper money. Gold is a key asset. Look at cryptocurrencies to the extent that you can make sense of cryptocurrencies. Why is Bitcoin elevated? Exactly the same reason. This is the fact. So people have got to recognize this. And therefore, in a world where you've got more and more monetary inflation going on, which is a fact of life, given these deficits and this debt burden, what you're actually facing is a situation whereby investors need to change their portfolio structure. They need to move away from what a lot of advisors say, which is a 60-40 equity bond split for their pension funds or whatever, and start to think more constructively about having dedicated monetary hedges to replace the 40% in government debt. You need to think about having more gold. Think about having maybe some cryptocurrencies. If you can buy treasury index-linked securities, which protect you against inflation, have maybe more cash. All these things are critical decisions to make.
Interesting points. I remember we talked about the gold sort of racing away and its comparisons and its parallels with Bitcoin, but also as a gear against inflation. And I mean, simultaneously, you're looking at over 90 economies for liquidity and where the money flows are going. I mean, casting that net that wide must be, again, substantial amounts of data. And as you said, gold in particular is raced away as well as Bitcoin. I mean, the underlying liquidity and where the monies are coming and going from a, cyclical point of view, I'd like to say that, these things, there tends to be patterns throughout time, but there's this clear explosion of debt, which does sort of change the equations a little bit. But I mean, where have you been seeing that real liquidity going towards, especially if I call to Australia, some of the housing prices are just going absolutely ballistic here as more and more people try and occupy and buy real estate and land, and there's other dynamics happening there. But where do you see liquidity and cash and all of that really being deploying, and where has the sort of flows been directed to?
Well, I think the first point to say is that liquidity, as we keep saying, is cyclical. And one of the important questions to therefore ask is, where was the cycle bottom? And the cycle bottom was around, well, in fact, it was precisely in October of 2022. Now, what woke policymakers up to an inflection was the British gilt debacle, when a new Prime Minister called Liz Truss came in with a very errant budget statement, and the market spooked. The British sovereign debt market, the gilt market, sold off aggressively, and the Bank of England sort of turned on a sixpence from doing a QT, quantitative tightening program, to a quantitative easing program. And actually the US Federal Reserve as well began to change direction in terms of its liquidity injections around that time. So what you've got is a very clear inflection. The Federal Reserve came in a few months later following the Silicon Valley Bank failure and injected still more money into the system. But you see this turning point, which basically began around October of 2022. Now, the important thing, therefore, to say is then where does it stop? And our estimate is that these liquidity cycles last about 5 to 6 years. So you've got to think about the end of the upswing being around about late 2025, late next year. From now until then, things may be tough, but at least markets are probably going to go up. Okay, that's the point. We've also had, at least 2 years of a bull market. Hello. Many people haven't recognized that. And as normal, bull markets climb a wall of worry. A lot of economists have been telling us that there's going to be world recession. Well, that's just a fake call. I mean, that clearly hasn't happened. Economies are slow, but so what? I mean, we've got an environment now where I keep saying to our clients, look, what's not to like? You've got a situation where central banks want to ease. They're sort of falling over each other to ease who's going to be the first or the most to ease. You've got economies that are slow, but not recessionary. And that's important because a very strong economy will basically absorb liquidity from financial markets. So if the economy is slow, then it doesn't need so much cash and there's more to invest. And then the third thing is you've got deflation in China. Now, if you've got deflation in China, that's keeping a cap on world inflation. So everything seems to tick a box to say, look, this is a bull market that's still expanding. And now what you've got is central banks are very publicly saying they're going to cut interest rates. I mean, you've got in the US, Jay Powell saying, hey, look, next FOMC, we're going to cut by 25 basis points. Well, I thought that their decisions were data dependent, number one, and formed by a committee. So how can he tell us, weeks ahead, they're going to do 25 basis points? Again, in Britain, you've got the head of the Bank of England saying exactly the same thing, that we're going to start cutting interest rates more aggressively than the market thinks. Well, how can he say that? I thought it was a committee decision. This is, they're using this forward guidance to try and tell people, school people into saying that rates are coming down. Okay, so now people are recognizing that the super tanker has changed direction and they're getting on board. But that super tanker actually began to shift direction, 2 years back. Okay, that's the reality in 2022. We are now exactly 2 years on from that. And the bull market has been going fueled through that time. As you start to get this evidence of monetary inflation affecting people, the average guy in the street is going to realize that inflation is not the 2% that these policymakers tell us. Okay, my personal inflation rate is a lot more than 2%. I'm sure yours is. Okay, these are just sort of bogus figures. It's a smokescreen. You've got inflation coming through, so that's why gold is going up. That's why Bitcoin is elevated. That's why prime real estate in Australia is picking up fast, right? Because people know, history tells you that these are fantastic monetary inflation hedges. What better to own land? They're not making any more. I mean, these are things you've got to start recognizing, and therefore this explains that phenomenon. And it's not, it's just a fact of life. Let's put it that way. And policymakers are changing. They're not necessarily reckless, but they're just changing the direction of liquidity. And this at the margin matters. You don't need that much liquidity coming into a market to change the pricing structure. And that's what we're seeing.
And you touched on there, I'd like to pull the thread a bit more about China. And, there's a lot of speculation that, maybe we don't see all the information coming from China, but I think you'd be remiss of yourself not to accept that they are one of the major players in the global economy. And the current state of the deflation, for those, and in particular myself, what is that really meaning? Like, keeping a lid on inflation, how is that really impacting global liquidity? And how do you see, we talked about it another time, about this almost two steps between how the US is approaching their problems and China are both on very different levels, but realistically, we need both sort of coming to the same potential for the benefit of really global economies. What are your thoughts on that?
Yeah, well, China is a big question. It's also a slightly complicated question, but let's try and sort of bite into it. The problem that China's got is that, or let's say the two problems that China has got is that, first of all, the model of rate capitalism, if you call it that, that has existed over the last 2 or 3 decades, no longer works. Okay, and that model was effectively a model that used the West as if you like a place to dump cheap goods, right? So they used export markets and China was sort of tried to make itself super competitive in certain industries, and it overproduced. I mean, the amount of electric cars that it's producing right now and the solar panels are just eye-wateringly large amounts of product that the world economy, even with a fair wind behind it, certainly couldn't absorb. So that is what's creating the deflationary problems that you've got in China. Now, how do you get around that? Okay, you've got solution number one is you cut back production significantly. Well, is that going to happen? I don't think so, right? Because then you question the whole Chinese economic model, and the CCP in China basically wants to create wealth for the average Chinese person, and they need a strong economy to do that. So if they don't do that, then the whole ethos or sort of raison d'etre for the Communist Party falls away. So they've got to do that, number one. So you're not really going to see them easing back significantly on this sort of planned economy model of overproducing goods. They may try and change the direction, but the whole philosophy, I think, continues. The second problem they've got is that the Chinese economy is de facto dollarized. Okay, they lean very, very heavily on the US dollar, and that's the other problem they've got. And clearly, one of the things that you've got going on right now, particularly evidence the sanctions that the US has put on top of Russia, and in fact the tariffs that it's imposed on China, or the constraints it's imposed on China already. The Chinese are clearly nervous that there may be some dollar sanctions ultimately put on them. So they want to try and get off the dollar hook, but it's not that easy. So what they're doing, one of the things they're doing is trying to build a rival financial system that I envision ultimately is going to be based around gold. So that's another reason that you're starting to see a lot of central banks starting to accumulate gold at a rapid pace. So they need that. So these are generally the issues. Now, because of the overproduction in China, what you've basically got is a situation where, in economics speak for a moment, the real exchange rate of China needs to fall to clear the market. So that either means Chinese prices fall, or it means the Chinese exchange rate falls. Now, the Chinese exchange rate is a measure in China's eyes of its soft power. Okay, it has, it doesn't want to lose face by devaluing the yuan, particularly against the US dollar. And this is important to them. They want to try and keep it elevated. The problem is if you need the real exchange rate to fall and you keep your nominal exchange rate artificially elevated, then you put all the burden on prices, and not just high street prices, asset prices too. So what you're seeing is a collapse in the price level. Now, that can only go on so far. And basically, what we're seeing is probably the end of the road on that. And what China needs to do is to basically start to stimulate its economy and somehow get the engine working again, where they can basically absorb this product. And that's what you're seeing evidence now in these packages. What they've said so far is nowhere near enough to actually get a change enacted. But what these changes reflect is the early stages of a super tanker changing direction. So there'll be a lot more announcements. There'll be more evidence of the People's Bank injecting more money into markets. There'll be evidence of the state-owned banks starting to increase their lending, but these will only evolve over coming months. So forget the 20 basis point interest rate cut. That's nothing. That's not having any effect. It's really a signaling device that we need to start thinking about, and that's probably what's happening. Now, to put this in context, does it mean that the yuan will devalue? Ultimately, yes, but there's been a window created, I suspect, by what the Americans have been doing. And I rather think there's been a deal which has been arranged here, whereby the US have allowed the dollar to temporarily weaken to take some of the pressure off China. And that's made the quid pro quo for that, maybe, some sua tabula deal that we just don't know about. Now, that could involve Russia and Ukraine. It could possibly involve the Middle East. It may possibly involve US Treasury buying. We just don't know. But maybe that's what's happening, because the dollar is starting to soften after a long period of strength, and the US is encouraging that by easing monetary policy. And an easing by the Federal Reserve after 5 years of tightening will have a big effect on the dollar. As the dollar goes down, it will give the opportunities for other countries in Asia, particularly China and also Japan, to ease their monetary policies. And lo and behold, look what's happening. They're doing exactly that. Will the Japanese tighten policy? Forget that. I mean, all this talk about Japan tightening policy is pie in the sky. They've got no ability with the debt burden they've got to tighten seriously. And now the new incoming prime minister has pretty much nailed that one by saying they don't want to tighten. So, what we've got is a general easing of monetary policy worldwide, which is fueling more monetary inflation. Now, next question is, which channels does this go down? If the Federal Reserve eases, or generally Western central banks ease, what you tend to find is financial markets get the main impact of that. So you'll see that in asset markets as rates come down. I mean, we live in a dollarized world, so the Federal Reserve has a big impact on financial markets. We know that. But when the People's Bank of China eases, and the People's Bank of China is the other big player in the world, it tends to affect the world real economy via the Chinese economy, because the Chinese economy has a very big industrial footprint out there. It will affect the world economy and hence commodity markets. So little wonder now that you're starting to see, a bid for key commodity prices outside of gold. I mean, the Federal Reserve may affect the gold price, but, copper, oil, ultimately, iron ore, all these things are basically the result of what the People's Bank of China ultimately does.
Fascinating. The dynamics at play, it just mind boggles me as to the implications and this potential, again, degree of change for these tankers. And, leading up towards, as you coined it, 2025 as this sort of pivotal moment, at least towards the end of 2025. I mean, where do you see sort of, or urge investors to really start considering and monitoring this? And probably ties into the services that you offer. But I mean, being across all this and to this extent and this depth is not something that anyone's just going to get by, again, chucking on Twitter and looking at a tweet, for example. This is some very, very detailed, in-depth knowledge and research. But in going back to my question, where do you sort of suggest people to be monitoring and looking towards, from an investment philosophy, towards this end of 2025?
Well, I think there's a number of things to look at, but I mean, there are different levels of complexity. I mean, we write a Substack piece called Capital Wars, which is actually named after a book I wrote a few years ago about this whole, global liquidity world and how it matters and what's going on. And that, gives I mean, it's a detailed narrative with data, but it tries to explain what's going on for sort of average people, if you like. If you sort of then say, well, okay, outside of that, what can people do to monitor the world? If you've got some level of knowledge of financial markets, I'd be looking at what the Federal Reserve is actually doing with its monetary operations outside of interest rates. I mean, interest rates are important. I'm not going to deny that, but they're not the whole story. Look at the balance sheet of the Federal Reserve. Look at what the People's Bank of China is doing. Those are clearly key metrics. Look at I mean, another thing, which is again probably going to get stuck in the weeds a bit here, but another thing is important is the level of volatility, particularly in the bond markets. So if the bond markets are stable and not particularly volatile, then you get credit providers with an ability to leverage up liquidity in the system. So that may be slightly wonkish, but I mean, those are things that are important. And then sort of, headline indicators that people can watch. What I would say is, look at the gold price. If the gold price is going up, that's normally very bullish for liquidity. And that's telling you that you should be thinking more generally about this diversification of portfolios outside of government bonds and into what I've called dedicated monetary inflation hedges. Things like gold itself, things like prime real estate, things like high quality corporate equities, things like index-linked government securities, maybe even cryptocurrencies. So these are the sort of things you want to start thinking about in a monetary inflation. So the gold price is one. Price of Bitcoin is itself a pretty good barometer of the amount of liquidity in the world. And that can be volatile, we know that, but it so happens, and it's absolutely the case because we've proved it statistically, Bitcoin tends to move about 3 months after a big surge in liquidity. So if you see that happening, the price of Bitcoin tends to move. Now, there are other things going on with Bitcoin. clearly. Okay, it's an emotional security, but generally the trend tends to move in that way. So, I'd be looking at those factors. Generally, the level of the dollar, I mean, you can pick the dollar up from the gold price itself, but generally the level of the dollar is important. And a softer dollar, not a collapsing dollar, but a softer dollar is also pretty bullish because it enables the rest of the world to reliquefy as well. And if you want to get, again, slightly more sophisticated, take a look at the slope of the yield curve, which is the difference between a long-dated bond, say a 10-year bond, and a very short-dated bond like a 1 or a 2-year bond. That yield spread is normally positive in an upswing, and it's negative. In other words, the short rate is above the long rate in a downswing of the liquidity cycle. So that's another benchmark for people to take. But, but I'm not going to say the world is straightforward. It's not. But, because things are not easy, doesn't mean to say you don't do them. And that's why we spend an awful lot of time poring over what central banks and policymakers are doing and looking at a whole range of countries.
Well, I don't think there's enough hours in a day for everyone to do it. And that clearly is where your niche has been carved out over this 30 plus years, sort of analyzing it. So for those that are interested and infatuated with it, I know you've got the Substack that's quite frequently updated and you post that to members. I mean, how else can people sort of follow your work and cross-border capitals and, again, get a bit of information, but naturally the subscription parts of it is where you get really the key parts of the cheese, if I could call it that.
Yeah, I mean, the institutional service is available from our website, which is crossbordercapital.com. And we provide data. We provide a lot of data to US quant firms, for example, in terms of what they do. We have databases that we curate specifically for quant investors. We provide, narrative around that for conventional investors. And we dig deeply into what's happening in liquidity markets. We've just done a piece on Bitcoin, for example. We've also done a piece on, why I mentioned this earlier, why bond volatility matters for the whole liquidity cycle. But that's, again, slightly wonkish. So again, the average probably really won't be interested in that. But for institutional investors, maybe that's interesting. So that sort of evidence is that. And then we've got Twitter, where we do the occasional tweets on handle, which is @crossbordercap. So there's a lot of different ways of sort of capturing this, and I occasionally do these YouTube videos. So there's probably enough handles or channels that people can hear what we say.
Yeah, I think now the prevalence of educational podcasts, like say financial podcasts like myself, where I get the pleasure of sitting down with you and picking your brain and understanding and just getting a glimpse of what's happening in your world. But yeah, there's all those channels, and I know that you'll be speaking on numerous other podcasts in the future and hopefully come back. And yeah, it's been an absolute pleasure. So thank you so much, Michael, for taking the time to speak with me today on the show.
Great, Ben. Thanks. Enjoyed it enormously. Thanks so much for your time.
Thanks for listening to the Market Bull podcast. Please remember that the topics and stocks discussed in this podcast are not financial advice. If you enjoyed this episode, please make sure to like, share, and follow. You can follow the Market Bull on all our socials and keep up to date with global market insights.